Hi, everyone. This is Dave Keller, Chief Market Strategist at StockCharts.com. And here is your Wrap the Week segment for Friday, March 6, 2020. So the market ends the week in a volatile stretch, down more than up, but in a stepwise motion getting down to these lows. But essentially, last week was the distribution. Earlier this week, we had a bit of recovery, but now we're back toward the lows. And the question now is, how does this week relate to the long-term trends? So we're going to slice that up a couple ways. We're going to start with a long-term weekly chart of the S&P, just to put this week's movement, the last 2 weeks, into proper context. Then we're going to look at a daily chart very quickly, think about the last 5 trading days. We're going to look at the Mindful Investor Live chart list, look at some of the, it's part of my weekly routine to understand the long-term trends and where they're at. We're going to finish with looking at some of the industries and other things that have moved from the scooter rankings, the StockCharts technical ratings. So let's get to it. So on the weekly chart of the S&P 500, I just wanted to point out that the last 2 weeks, from peak to trough, if we take the low from the last 2 weeks and the peak from the last 2 weeks, we're down just under 16%, right around 16% over that period. Now, when we're looking back to the left on the chart, you're thinking of initial moves down after a longer uptrend, and 3 other periods kind of come to mind that are most similar to what we're seeing right now. The first is sort of late 2018, that sell-off going into October, into November, which ended up resulting in the market low in December 2018. The second period is that first sell-off in 2018, which is January into February. And then the third one is the first sell-off in that cyclical bear trend in 2015 to 2016. If you'll note, each one of these was about 11.6 to 12.5%. So all about that, around 12% of a sell-off. You can see that this sell-off a little meatier, right? So it's feeling a little different, and I think that's one of the key to my key themes to the thesis I'm going to present to you, is that this is a little bit different than some of the previous sort of traditional pullbacks within a longer-term uptrend. This feels a little different to me. So that's sort of what the initial decline looks like now. And again, 2 of these ended up resolving in lower moves. So in the beginning of 2016 and then the end of 2018, this was the first step of a multiple step downward process. In January 2018, it was different. It was a sell-off, and then it was more of a time correction. We really didn't eclipse those lows and ended up making new highs about 6 months later. So again, it's a little bit of history to go on, not a ton. Let's look at a daily chart of the S&P 500. Here's that same 16% sell-off from peak to trough. And then this is what this week has done, which was more of a reaction move. And again, when I'm thinking of this week, I'm thinking of the 200-day moving average, because again, when people ask me why I pay attention to it, it's because of weeks like this where we trade around it. And I've worked with so many institutional investors that are aware of the 200-day. If they look at a chart, it has the 200-day moving average. So I'm always going to want to know where it is, because that fuels how they're thinking about some of these moves. And if you look, we sort of day to day closed above and then back below. On Wednesday, it felt relatively positive because we got back above that 50% retracement level, back above 3120, but then we went right back down Thursday, back below the 200-day. Today, we're getting a follow-through. We finished a little stronger on Friday's session, but overall, again, closing pretty low to a new closing. No, not quite there, but settling in around 2970. So let's look at the Mindful Investor chart. Let's look at some of these longer term trends. So again, one of the first charts I look at in my weekly routine is a long-term weekly chart using the 21 and 34 week exponential moving averages. Still positive. I can see that from the PPO here. As long as this is positive, it tells you the shorter term still above the longer term. This is not designed to trigger very often, and certainly takes quite a while. You can see like here at the end of 2018, it took quite a while for it to trigger as a sell signal. It's meant to really prevent those huge climactic secular declines. That's what it's trying to identify. The shorter term, more tactical read for me is a weekly PPO using the traditional settings, 12, 26, and 9. This is kind of how it looks. So it gave a sell signal a couple weeks ago, actually, and has remained negative. So overall, it's suggesting weakness in the short term. Until that turns up, it's telling you to be a little more defensive, especially in the short term. The next chart is the S&P breadth by cap tiers. Now, some of these breadth readings on our system don't update until after the close. Sort of, I have to polish all the data, make sure everything's clicking right. But overall, it's probably going to look similar to this, if not a little bit weaker. These are all, very unscientifically but subjectively color-coded based on my visual analysis. And when they've all eclipsed the most recent swing low to the downside, that all feels more weaker than stronger to me. And so from large cap to mid cap to small cap, and then the broad NYSE here, second from the top, all four of those really more negative than positive, suggesting to you that the trend is negative, the breadth is negative. I want to look briefly here, new highs and new lows. So these are stocks on the S&P 500 at the bottom making new 52-week highs and 52-week lows. You can see the last couple of weeks we've had very few, just a couple new highs, but pretty much everything else is down here. We had about 100 S&P stocks on the initial pullback last week, so 20% of the S&P making a new 52-week low. Today we actually had about 25%, 126 out of 500 stocks. This is starting to look a little more like some of these deeper declines. If you look back here, end of 2018, going into the market low, we got that low, and then again it was in the cyclical bear market back here in 2015, 2016. So, again, it's not looking like some of these garden variety pullbacks from 2019. It's looking more like some of the deeper corrections that we've seen going back in history. And that's why I think there's more downside, both price and time, I think, to go before all is said and done. Here's the percent of S&P 500 stocks above their 200-day and above their 50-day moving average. Wanted to note that at the initial big sell-off here, you can see that the percent of stocks above their 50-day got all the way down to about 3%, and that's similar to what you saw at the market low in 2018, also the initial pullback in 2015. So it's lining up with some of those big cyclical declines. But I think what's more telling is up here. We talked about this earlier in the week, where that 50% line, as long as 50% of the S&P remains above their 200-day, it tends to be more of a shallower or more of a short-term decline within a longer-term uptrend. We saw that in a lot of the first half of 2018. We saw this in much of 2019, even back here in 2016 when came out of that cyclical bear market and started to see some of those pullbacks. We never really got below 50%. You can see, though, that now, again, we're lining up more like that initial decline at the end of 2018 back in September, October, also the decline in mid-2015, both of which led to deeper lows. And I think that's why I'm sort of expecting that here. The AAII rankings are a subjective vote, a survey of individual investors. Are you bullish, bearish, or neutral on stocks? You can see that similar number of bears from last week. This came out on Thursday. Number more bears from 30% up to 39%. So that keeps it about dead even between bulls and bears. So pretty even on both sides of it. And I think that indecision, that lack of direction is really what the market felt like this week. Even though it was more weaker than stronger, in general, it was more choppy, volatile, right? This is one of the ratios we look at, consumer discretionary versus consumer staples. Both of these have broken down on a cap-weighted and an equal-weighted basis. We've noticed the weakness in the equal-weighted consumer ratio for a while now, and now it's all sort of validating this move more towards defensive. So I'm painting sort of a negative picture. I did just want to point out there are places that don't feel climactically bad, so it's not the end of the world. The fact that semiconductors have actually held up on a relative basis is just the ratio of the SMH versus the spider. So the semiconductor ETF versus the broad S&P 500, it's been flat for the last 2-3 months and year to date especially. So even with the market sell off, semiconductors are not underperforming. They're sort of holding step. If you would see them start to really underperform, I think that would tell you something to potentially worry about. And then the last ratio before we get to the scooter rankings is small caps. So the IWM continuing to severely underperform large caps. So that's not just a bull market condition or a corrective pattern. This has been happening for quite a while, and that has not shown any signs of alleviating it. To finish up our wrap of the week, I just want to look at the scooter reports. I like to look at it by industries. I like to set it to 1 week. If you don't look at this too often, you should do yourself a favor, go to Charts and Tools, Scooter Reports. You'll get to a page like this. I'm setting it to U.S. industries 1 week, and I'm starting with the industries that are the top rated. It's mining stocks, gold mining, then we get into automobiles, computer hardware, then you get into water. It's sort of a mishmash of things here, but a couple healthcare groups that are noteworthy and some technology. So it's worth noting some of those, but also a lot of other things, utilities, real estate, all sort of represented, home builders in here as well. So make sure you take a look at some of those groups that are holding up pretty well, still rating pretty high. In terms of the biggest gainers this week, we see things like gas distribution, mortgage finance, food retailers, wholesalers, water, utilities, personal products. These are all very defensive plays in consumer staples and financials and utilities. So it's certainly showing a flight to safety there. On the downside, you had publishers, the worst group over the last 5 days, industrial machinery, apparel retailers, durable household products, gambling. So a number of things that are tied to, obviously the coronavirus concerns, Asia. So a lot of gambling stocks have sort of implications for, Chinese casinos and so forth. So a lot of interesting themes there as well. Semiconductors actually one of the worst groups in the bottom 15 this week. But again, overall on a relative basis, hanging in there okay. That's your weekly wrap for this Friday, March 6, 2020. You can catch all of our previous episodes of The Final Bar on our YouTube channel. This is Dave Keller from Redmond, Washington saying have a great weekend. Stay safe, everyone. Thanks a lot.